Have you ever pondered over the concept of using debt to buy assets? It might sound counterintuitive, but it's more common than you think. Let's start by defining our terms. Debt is money borrowed that needs to be repaid over time, often with interest. Assets, on the other hand, are items of value that you own. These can be tangible, like a house or a car, or intangible, like stocks or bonds. Now, imagine using borrowed money to buy assets, with the goal of those assets generating income. That's the basic idea of using debt to buy assets, but not all debt is created equal. There's good debt, which can generate income or increase in value over time. And there's bad debt, which does nothing for your financial growth and can be a drain on your resources. Now that we have a basic understanding of what it means to use debt to buy assets, let's dive deeper into the process. So, how does one go about using debt to buy assets? Here's a simplified step-by-step breakdown. Firstly, it's all about identifying the asset you want to buy. This could be real estate, stocks, a business, or any other income-producing asset. It's like shopping for a new car, but instead of looking for horsepower and heated seats, you're looking for potential return on investment. Speaking of which, that's step 2. Determine the potential return on investment, or ROI. This is where you put on your financial detective hat and dig into the numbers. You need to estimate how much income the asset will generate over time. Will it be a slow, steady earner or a fast-paced moneymaker? Step 3 involves a bit of a comparison. Compare the cost of borrowing, the interest rate on your loan, for example, with the potential return on your investment. This is a bit like weighing the pros and cons, except in this case, it's all about the dollars and cents. Is the juice worth the squeeze? If the potential return outweighs the cost of borrowing, you're ready to take the plunge. This is where step 4 comes in. Proceed with the debt. You've done your homework, crunched the numbers, and decided it's a risk worth taking. Step 5 is straightforward. Use the borrowed money to buy the asset. It's like buying a ticket to a show, but instead of a night of entertainment, you're hoping for a long-term stream of income. Once the asset is in your possession, it's time for step 6. Use the income generated from the asset to pay off the debt. If all goes well, the asset will essentially pay for itself over time. Finally, step 7. Once the debt is paid off, any further income from the asset is pure profit. It's like having a goose that lays golden eggs. Over time, those eggs add up to a sizable nest egg. And that, in a nutshell, is how you can use debt to buy assets. But remember, it's not without its risks. Using debt to buy assets can be an effective wealth-building strategy, but it's crucial to approach it with caution. Let's take a moment to revisit the key points. First, we discussed the process of using debt to purchase assets. It's not just about taking on any debt, but rather strategically leveraging debt with a purpose. Next, we stressed the importance of comparing the cost of borrowing to the potential return. Remember, the goal is to ensure your return exceeds the cost of debt. We also highlighted the necessity of understanding the risks involved. Every financial decision carries some risk, and it's essential to be fully aware of them before diving in. So there you have it. That's your quick guide to using debt to buy assets. Remember, it's not about getting into debt. It's about leveraging debt to build wealth. Thank you for watching. If you found this video helpful, please like, share, and comment. Don't forget to subscribe for more informative content.